Thank you for joining us at XM.com, and this week ahead we'll be looking at key data releases from the United States and Japan that might prove important for the respective currencies and market rate cut expectations. I'm Cristina Marujas. With me today is Marios Hadjikyriacos, our Senior Investment Analyst. Marios, Fed Chair Powell kept the door open for rate cuts this summer, even as the Fed revised up its inflation forecasts. Now, the Fed's preferred inflation metric, the core PCE price index, is coming up on Friday. What could that mean for the market's rate cut expectations and, of course, the dollar?
Hello, Christina. It was a huge week for the Forex market. We had 5 central bank meetings, a lot of volatility in the major currencies. Now, the Fed was a little bit surprising. As you pointed out, they revised their inflation forecasts and their growth forecasts higher, but they continued to signal 3 rate cuts for this year. Now, the overall message I got, Christina, was that they'll probably start cutting interest rates in the summer and that they seem to be willing to let inflation run hot for a while longer if that means minimizing the risk of a recession. So they are trying to achieve their soft landing. Now, the reaction in the dollar was negative. Traders sold the dollar, but the greenback managed to recover those losses. And in fact, it's about to close the week much higher overall because other major currencies ran into their own problems and they fell even harder. So the euro was hammered by some disappointing business surveys. The British pound fell after the Bank of England opened the door for a summer rate cut, and the yen has been soft overall. So next week, as you pointed out, the focus will turn to the core PCE price index. That's the Fed's preferred inflation measure, and the forecast is for the core PCE rate to have held steady at 2.8% in February. That would essentially reaffirm that the progress on inflation has stalled recently. Now, beyond the economic data, Christina, the performance of other major currencies will also be crucial for the dollar, like we saw this week, and how global risk sentiment evolves will also be important for the dollar, which of course is a safe haven. So in this sense, I think that for a lasting rally in the dollar, we might need to see a pullback in the stock market that fuels demand for safe haven assets and some more signs of weakness in foreign economies. That's what the dollar needs to stage a proper rally. Now, a final note on this: Friday is going to be a public holiday in most major economies, Christina. So stock and bond markets are going to be closed. The FX market, of course, will be open for business, but liquidity will probably be very thin, especially since it's also the end of the quarter. So in that type of environment, we could see some sharp moves in the FX market without any real news behind them.
Now, Marios, let's cross into Japan. The yen took a hit this week, despite the Bank of Japan's first rate hike in years. Now, Tokyo CPI is on the upcoming week's agenda. Could it offer the yen any support?
So look, the yen has not been able to capitalize on the Bank of Japan's rate increase. I think the market was disappointed because the Bank of Japan didn't provide any signals about future rate increases. And I think a lot of traders are concerned this rate increase might have been a one and done kind of move, especially since most other central banks are preparing to cut interest rates. So we're going to get the summary of opinions from that meeting on Thursday. We'll also get the Tokyo CPIs on Friday. Those are going to be important for the yen. Now, the yen is trading very close to the 151.90 region against the dollar. That is a 34-year low, and this area, Christina, has been tested multiple times in the last 2 years. In fact, Japanese authorities intervened in the FX market to defend it as well. So it holds a lot of importance. So how the market behaves around this region is going to be telling. If this region holds strong, once again, that leaves some scope for a yen recovery during the spring. Whereas a break of that region would signal a resumption of the longer term downtrend in the yen. Now, of course, a break would probably draw more FX intervention warnings from Tokyo, so that could slow the pace of any sell-off.
Marios, thanks so much. This was the week ahead here at XM.com.